Have you ever wondered why so many people lose money in the stock market, even when they think they're doing everything right? Let me give you a quick example. Imagine stock A is worth $100 a share and pays a 5% annual dividend. Stock B is also $100 a share but pays an 8% dividend. Which one sounds better? Most people would jump at stock, B higher dividend, right? But here's the truth. It really depends. And this is where a lot of investors get burned. Let's look at a real-life example. UPS versus McDonald's. Right now, UPS offers around a 7% dividend, while McDonald's is closer to 2%. On the surface, UPS looks like the clear winner. But let's look a little deeper. Over the last 5 years, UPS stock has dropped nearly 50%, while McDonald's has gone up about 50%. So, the McDonald's investor actually walked away much richer, despite that smaller dividend. This brings us to the very first mistake I see all the time: chasing high dividends instead of looking at the actual asset. And in today's video, I am going to walk you through the 7 biggest investing mistakes that drain people as wealth, so you can avoid them for good. Alright, let's dive into mistake number 1. Focusing only on dividends, not the company itself. Now, don't get me wrong, I love dividends too. They can give you that sweet cash flow so you don't have to work forever. But dividends alone do not make an investment a good one. Imagine a company's stock drops from $100 down to $50, but it's still paying a $3 dividend. Suddenly, that looks like a 6% yield instead of the original 3%. Sounds amazing, right? But it's a huge trap if that company is actually tanking. If it's headed toward bankruptcy, you're not just losing the dividend, you're losing your entire investment. That's why you have to ask the important questions. Is this company solid? Is the leadership team any good? Is the business innovative and growing? And most importantly, are they profitable? If the answer is no, that high dividend is just bait on a hook. Next up, mistake number 2. Following what's hot instead of doing your own research. We've all been there. You hear about some stock that's exploding. Maybe you see it on the news, on Reddit, or on Yahoo Finance, and that FOMO. That fear of missing out starts to kick in. But here's the hard truth. By the time you see it in the news, the big money has already been made. Real, successful investors don't chase headlines. They dig into the data and the fundamentals long before a stock becomes trendy. If you're just buying what everyone else is hyping up, you can't really expect to get better returns than the crowd, can you? Mistake number 3 is a big one. Investing before paying off high-interest debt. Let's do some quick math. Let's say you put $8,400 into the market and, be some magic, you earn 25% returns every single year for 30 years. That could grow into nearly $7 million. Sounds incredible, right? But here is the reality check. The average American household carries thousands of dollars in credit card debt, often with interest rates between 20% and 28%. So, if your debt is costing you 25% a year, but your investments are only earning, say, 10% on average, you are actively moving backward. It's like trying to run a marathon with 100-pound weights strapped to your legs. Before you even think about investing, you've got to pay off those high-interest debts. Otherwise, your money is working against you, not for you. Now for mistake number 4. Investing more than you can actually afford to lose. I saw this happen so much. Back in 2022 when the market dropped 20%. People were panicking, saying things like, "I don't know how I'll pay my rent if the stock market keeps crashing." But here's the thing, your rent money should never, ever be in the stock market. You should only invest what you can comfortably afford to set aside for the long term. Treat it like money you won't need for years, maybe even decades. That way, when the market inevitably dips, you're not panicking and selling. Instead, you're looking at it as an opportunity to buy more at a discount. This leads us right into mistake number 5. Buying high and selling low. This is classic investor psychology in action. The market goes up, the news gets loud, and everyone feels like they're missing out. Your Uber driver is bragging about his stock gains. Your neighbor just bought a brand new Tesla, so you jump in and buy. 2 usually right at the top of the market. Then, the market tanks. Panic sets in the headlines, scream recession, and people sell everything at the bottom, locking in their losses. That cycle makes other, more patient investors rich, while you lose your hard-earned money. Smart investors do the exact opposite. They buy when prices are low and fear is high, and they hold on for the long term. And that brings us to mistake number 6. Thinking short-term instead of long-term. Most people treat stocks like they're lottery tickets. They're checking prices every single hour, getting nervous when it dips a few dollars, and selling way too soon. But think about it this way. If you bought a house, would you check Zillow every hour to see if its value went up or down? Of course not. You'd hold it for years. The best investors think the exact same way about their stocks. They zoom out and focus on decades, not days. That's how true wealth is built, through compounding. Finally, mistake number 7, ignoring fees. This one is sneaky because it's almost invisible. Whether you're investing in a 401k, a mutual fund, or using a financial advisor, you are paying fees. And those tiny little percentages add up to a staggering amount over time. Let's say you invest $1,000 a month for 40 years at a 10% average return. Without any fees, you'd end up with about $5.8 million. Not bad. But if you're paying a tiny 0.2% fee, your total drops to $5.5 million. That's a $300,000 difference. And what if you're paying a 1.5% advisor fee? Now you only end up with about $3.8 million. That's a massive $2 million hit to your retirement, just from fees. Now, sometimes fees are worth it if you need the guidance, but you should always know exactly what you're paying, because small percentages over decades can literally cost you millions. So, let's quickly recap the 7 deadly sins of investing. Chasing dividends without checking the company's health. Following hype instead of doing your own research. Investing while drowning in high-interest debt. Putting in money you can't afford to lose. The classic, buy high, sell low. Thinking in days, not decades. And finally, forgetting to factor in those sneaky fees. If you can avoid these common traps, you will be ahead of 90% of other investors out there. And here is the big takeaway from all this. Building wealth in the market isn't about getting lucky. It's about discipline, patience, and avoiding these simple mistakes. Now, I want to hear from you. Which of these mistakes have you made before? Be honest. Drop a comment below and let's talk about it. And if you've got any value from this video, please hit that like button. Share it with a friend who needs to hear this. And subscribe so you don't miss the next one. Because remember, the market will always go up and down. But if you play the game smart, your wealth can keep going up. Thanks for watching.